Everyone's got an opinion on LA's commercial real estate market in 2025. Some say it's in free fall, others say it's just in flux. But here's the truth. LA is facing some of the biggest structural challenges it's seen in years. And if you're in this business, you're feeling it. Deals are slower, costs are up, and risks are higher. This isn't just a cycle, it's a reset. In this video, we're breaking down the 6 biggest challenges shaping LA commercial real estate right now, what they mean for investors, tenants, and owners, and how smart players are adjusting. This isn't about negativity, it's about market clarity, because if you understand the pressure points, you can start seeing the opportunities underneath them. Let's get into it. Number 1, homelessness and public safety. Let's start with one of the most visible and sensitive issues. Encampments near commercial properties, whether retail, multifamily, or office, have become a growing concern in many LA neighborhoods.
Across the city, the tents stretch everywhere. From Hollywood to Venice Beach, scenes from what could be a disaster movie. Now, a seemingly permanent fixture on the streets of Los Angeles.
Rising rates of break-ins, vandalism, and loitering don't just create operational headaches, they're directly impacting leasing activity and tenant retention. It's not just about crime stats, it's about perception. Tenants, employees, and residents are making decisions based on how safe they feel, not just what the data says. And when safety becomes a question mark, it's harder to attract new tenants, especially in competitive submarkets. Some businesses are adding private security. Others are relocating altogether. And for property owners, it adds a layer of cost, risk, and complexity that affects net operating income and valuation. But here's the bigger picture. This isn't just a real estate problem, it's a citywide challenge, and it's going to take coordination between public officials, community organizations, and the private sector to find sustainable solutions. Because until we do, the issue will continue to weigh on LA's commercial real estate recovery. Number 2, local legislation gridlock. Next up, the red tape. Building in LA isn't for the faint of heart, and it's only getting tougher. From permitting delays that stretch into years to zoning codes written decades ago, LA's development pipeline is often choked before it even begins. Developers frequently face shifting requirements, unclear timelines, and a patchwork of neighborhood-specific restrictions that make even buy-right projects feel uncertain. Even experienced firms with strong local teams are finding it difficult to navigate the process efficiently. It's not uncommon for projects to sit in entitlement limbo or be redesigned multiple times just to meet a moving target. And it's not just new ground-up development. Adaptive reuse, tenant improvements, even basic remodels can hit bureaucratic snags that add cost, delay revenue, and ultimately make deals harder to pencil. That said, high barrier markets like LA also create long-term value for those who break through. The lack of easy supply means the assets that do make it to market often command a premium. Still, for a city facing housing shortages, job creation goals, and infrastructure needs, streamlining development should be a priority, because right now, the legislative gridlock isn't just slowing down projects, it's holding the market back. Number 3, rent control expansion. Let's talk about regulation, specifically rent control and tenant protections, which have seen major expansion in LA.
I'm Pat Harvey. The tenant protections put into place because of the pandemic were set to expire at the end of the month. But now, the LA City Council has just voted to give renters more help.
For multifamily owners and investors, the landscape has changed significantly. From city-level rent freezes to extended eviction protections and aggressive enforcement of tenant rights, the playbook for operating rental housing in LA has been rewritten. The goal of these policies is understandable: affordability and tenant stability. But the reality for many landlords is that margins are being squeezed and risk-adjusted returns are harder to justify. It's not just about caps on rent increases. It's about uncertainty. Rules shift year to year, and in some cases, month to month. This has led to a clear trend. Some institutional capital is pulling out of the market or redirecting funds to jurisdictions with more predictable regulatory environments. Deals that may have worked 5 years ago do not pencil today, not because of operating costs, but because of exit risk. At the same time, we're seeing a new kind of investor step in, one that's more focused on long-term holds, mission-driven housing, or creative value-add strategies that factor in the new rules from day one. The challenge isn't just rent control, it's regulatory volatility. Investors can manage rules. What they can't manage is surprise. And that's something LA will need to address if it wants to attract consistent capital into its housing stock. Number 4. Measure ULA fallout. Measure ULA, also known as the mansion tax, was passed with the intent to fund affordable housing, but its impact on the commercial real estate market has been significant. The measure imposes a 4% and 5.5% transfer tax on all real estate transactions over $5,150,000 in the city of Los Angeles. And while it was positioned as a tool for social good, the unintended consequences have been hard to ignore, especially in commercial real estate. Transaction volume has dropped off sharply. Deals are falling out of escrow. Listings are being pulled, and buyers and sellers alike are hitting pause, not because they don't believe in the market, but because the tax has thrown off their number. In a low cap rate environment, an additional 4% to 5.5% at sale cost can completely erase investors' margin. This led to widespread repricing, creative deal structuring, and in some cases, a full-on freeze. Brokers and legal teams are working overtime to find workarounds, like entity sales, seller financing, or shifting assets around in trust. But the uncertainty has created a chilling effect, especially on mid-sized deals. To be clear, the need for more housing is real, but when policy disrupts deal flow without clear pathways to replace or reinvest capital, the whole market feels the drag. Measure ULA may have been well-intentioned, but right now, it's a major factor slowing down commercial activity in LA. Number 5. Skyrocketing cost of living. One of the most persistent challenges in Los Angeles is also the hardest to fix, the cost of living.
All right, living in LA County is about to get more expensive. Starting tomorrow, our sales tax is going up.
Some cities will see steeper increases. Here's a look at your screen. This map actually paints a clearer picture. Places like Palmdale and Lancaster will see an increase to more than 11%.
LA has always been expensive, but in recent years, that cost has become a critical pressure point across the entire commercial real estate ecosystem. Tenants, whether they're retail brands, office users, or residents, are being stretched thin. And when your customers, employees, or renters can't afford to stay in the city, it creates downstream effects for every asset class.
How much do you need to earn annually to feel financially comfortable in different metropolitan areas? And the numbers are a bit eye-opening, if not surprising. According to this report, you would need to be pulling down nearly $111,000 a year in Los Angeles to feel financially comfortable.
Retailers are seeing slower foot traffic. Office users are grappling with employees relocating out of state. Multifamily landlords are facing rising delinquencies and growing resistance to rent increases, even when demand is strong. On the ownership side, it's not much easier. Insurance premiums, property taxes, and labor costs continue to rise, while rent caps and operating restrictions limit revenue growth. That squeeze between rising expensive and flattening income is eroding margins and putting pressure on valuations. The cost of living crisis also feeds into broader migration trends. People are leaving LA for cities like Phoenix, Austin, or Las Vegas, where housing is cheaper, taxes are lower, and business costs are more predictable. But despite all that, LA still draws people for the culture, the climate, and the opportunity. The challenge is, can the city evolve in a way that keeps those people here long term? Because affordability doesn't just affect tenants, it affects the future of the entire market. Number 6, capital shifts. Finally, let's talk about capital and where it's going. Over the past few years, we've seen a noticeable shift in where institutional money is flowing. Major REITs, private equity firms, and family offices that once prioritized LA are now relocating funds to markets like Dallas, Miami, Nashville, and Phoenix. Why? It comes down to one word: certainty. In those markets, there's typically less regulation, lower taxes, and faster permitting. Investors can underwrite a deal and have a clearer sense of how it will perform 5 or 10 years down the line. In LA, between new taxes, tenant protections, policy shifts, and ongoing legal challenges, predictability is harder to come by. That doesn't mean capital is abandoning LA altogether. In fact, the city still attracts long-term global investors who understands its fundamentals: port access, a diverse economy, world-class universities, and a massive population base. But what's changed is the tone of investment. It's more cautious, more selective, more focused on niche plays like industrial, life sciences, or value-add multifamily in submarkets with proven resilience. For brokers and operators, that means the old model of build it and they will come is no longer enough. Success totally depends on creativity, precision, and the ability to structure deals that make sense in a more constrained environment. Capital hasn't disappeared from LA, it's just become smarter, and the firms that adapt with it are the ones that will keep winning. So where does all this leave LA? Los Angeles commercial real estate is facing real challenges. No sugarcoating that. From homelessness and permitting delays to regulation, affordability, taxation, and capital flight, it's a lot, and it's happening all at once. But here's the thing. LA has been through cycles before. It's a city that reinvents itself, sometimes slowly, sometimes painfully, but always forward. Yes, this moment calls for adjustment, smarter underwriting, new strategies, more collaboration between the private and public sectors, but it also calls for perspective, because underneath the headlines, LA still has what investors around the world are looking for: scarcity, scale, and staying power. Markets evolve, policy changes, but fundamentals matter, and in the long game, LA's fundamentals are hard to replicate.